We're now a few weeks past the worst of the winter, and even though mortgage rates have bounced off the recent lows, the cost of mortgages is still 60 basis points lower than last year at this time. The improved affordability has led the first 9 weeks of the year to have about 2.7% more pending home sales than last year at this time. Each of the last 3 weeks have come in with like 4 to 5% more pending home sales than a year ago. We lost a couple of weeks of growth due to the big storms and deep cold, but that's behind us now. Still, 2.7% growth is not a lot. The total sales for the first 9 weeks of the year are still 21% fewer than 2022. So this market is improving slowly, but has a long way to go. And then suddenly we have new variables to worry about. So the latest job market data shows a weakening labor market. In a broad sense, a weaker job market tends to help interest rates move lower. The outlook for 2026 has always had a question of which of those trends would win in the minds of consumers. So as of now, unemployment is still relatively low, but the economy is losing jobs and the hiring rate is low. Since relocation for work is one of the great drivers of the housing market, weak hiring is going to keep the housing market slow. So for now, we have weak jobs, but lower rates. Suddenly, there's another new variable. The recent war has thrown some markets into a bit of fast chaos. Oil prices are spiking, and that drives inflation fears, which moved interest rates higher. So often, global uncertainty like war might help U.S. interest rates move lower. But for now, the market seems to be focused more on the inflationary impact of oil. So we may get a double whammy of a cooling jobs market and higher interest rates. So this is a really clear example to me of how hard it is to try to time the market. 2 weeks ago, there were home buyers sitting on the sidelines because they saw mortgage rates decline and assumed that that would keep happening. No one wants to buy and then suddenly feel like they overpaid. But the fallacy is that we think we can predict where interest rates will be. The latest news illustrates that we cannot. So here's where we stand today. Mortgage rates are significantly lower than a year ago. The latest pending sales data shows the strength you might imagine from that. But global turmoil makes it hard to predict what's next. So if we're lucky and mortgage rates stay in the low sixes through March, I suspect that the sales growth rate will continue. Meanwhile, even as sales are growing, home prices remain under pressure for most of the country. Lots of data to cover today. I'm Mike Simonson. I'm the chief economist at Compass. I do these videos every week so that you can stay on top of the latest trends in the housing market. Most real estate headlines are way behind the actual data, so be sure to subscribe here so that you don't miss any of the changes in the market. All right, let's look at the details of the latest data for early March 2026. Home sales are definitely stronger than they were last year at this time. So with the exception of those big 2 storm weeks, every week this year we've counted more pending home sales than the same week a year prior. So as I mentioned, these are not huge gains, but they're real. There were 4.1% more new contracts started this week than the same week in 2025. That's meaningful growth. The recent 4-week average is 3% greater than a year ago. And then for the full year to date, we count 2.7% more sales contracts started in 26 than in 2025. So 650,000 sales contracts this year versus 633,000 a year ago. So in fact, this week we counted more new pendings than in the same week of 25, 24, or 2023. Back in 22, there were a lot more sales still happening. So the point is that the data continues to show a slight growth trend. The blue line here is showing each week above the purple line from last year. You can see a couple of weeks in early February where the storms forced fewer sales. To me, this sets us up for decent growth in unit volume for Q2, which is the biggest home buying season, of course. So we're set up for that. But of course, who knows what happens to global financial markets in the next few weeks? So the growth I'm sharing is real, but it's also quite fragile. So here's a really interesting trend in the data recently. So even though the sales rate is coming in above last year, the new listing rate is not growing compared to last year. As we enter March, there are more sales and fewer sellers than a year ago. So this week we counted 62,000 single-family homes newly listed on the market. That compares to 64,000 last year. So this week had 4% more sales and 3.5% fewer new listings than a year ago. This tells me a couple things. First, it shows us that inventory is not going to grow quickly, if at all, this year. More on the inventory trend in a minute. It also says to me that there are potential sellers who don't know that there are more buyers out there now. So this isn't uncommon. I like to point out that when rates fall, demand moves faster than supply. If you're a potential seller, this is something to keep in mind this year. Being able to move quickly may work to your advantage compared to your competition. The takeaway for the new listings data is simply that right now, we're seeing buyer demand pick up faster than sellers. So, sales are up and new listings are down. As a result, the available inventory of unsold homes on the market declined for the second week in a row, dipped. The total inventory of single-family homes is now just under 687,000. That's 6.9% more homes on the market now than a year ago. Remember last year at this time, inventory had grown by 30% over the year prior. Now we're under 7%. So nationally, we've entered the period of mortgage rates easing lower, and as a result, there is not a lot of inventory growth anymore, and it might turn negative this year. So as I mentioned, demand moves faster than supply, and you can see that here. The blue line is getting close to the inventory levels of that 2025 purple line. This coming week is when we enter the spring housing market in earnest, so I expect inventory to rise by maybe 1% this coming week. Last year, inventory jumped by over 2% at this time. Last year, the mortgage rates were much higher, and so the spring housing market was super soft, and inventory climbed. So we're in a different market now. If we're lucky, this year's conditions don't deteriorate. As of now, mortgage rates are still in the low sixes. Buyers are motivated faster than sellers, but who knows what global chaos might do to our financial markets. So stay tuned. So even in an improving demand market, home prices can continue to be roughly unchanged from last year nationally. Many measures of home prices are actually below last year at this time. The median list price of single-family homes in the U.S. right now is $429,000. That's 1.4% lower than last year at this time. So the chart here is a 13-week rolling average of list prices. So it's a very clear illustration of the trend I'm talking about here. Home prices are just below, but basically unchanged for 2 full years. This year's blue line is below both the purple line from 25 and the orange line from 2024. One rule of thumb for understanding home prices now is that they are driven by inventory changes of a year ago. Last year at this time, inventory had climbed by 30% over 2024. Those huge supply increases last year are full of market signals. Those signals, though, take some time to filter into the minds of home sellers, often a full year. So if I'm a seller now, I'm using information I learned from my neighbors over the last year. I know what sold and what didn't. I know who did price reductions. Since houses can take months to sell, supply changes now generate signals that build up and finally show up in price data next year. Last year's 30% inventory growth is visible in prices being flat or down now. So what's really interesting is what we just discussed. Inventory now in 2026 is up only 7%, less than 7% compared to last year, and could go negative by the summer. So if that happens, that implies a little home price resiliency in 2027. So we're already starting to get some visibility on home prices for the next year. That's looking at list prices. There are other ways of measuring home prices also. So some of those are still positive compared to last year. Some are negative. So for example, the median price of those newly pending contracts this week came in at $390,000. That's been averaging about 1.6% above last year still. So still just barely positive. I've shown price per square foot in these videos recently. On a per square foot basis, prices are below the same point in 2025. The takeaway for home prices is that the primary story has not changed. We're expecting a roughly flat year for home prices this year. As of this week, I'd say the preponderance of the data indicates that the momentum would be to the low side, not to the upside on prices. In other words, we can see demand improvements in the number of sales underway, but we do not yet see those demand improvements lifting prices. Maybe not till next year. Let's wrap up this week with a look at price reductions. The percentage of homes on the market that have taken a price cut from the original list price is now at 32.7%. That's slightly fewer than a week ago. The signal on price reductions is to confirm the other indicators of mildly improved demand this spring. There's nothing in this data that suggests that home prices will move significantly higher or significantly lower this year on average across the country. What we can see here is that there are fewer price cuts now than a year ago. And last year that number was increasing where now it's not. So if you're sitting on the sidelines because you expect home prices to fall fast, there's nothing in the data that indicates that coming. So that's just something to be aware of. Okay, that's all the data we have time for today. Remember to subscribe to get the latest housing market data every week. We do these videos every week. There's so much going on in this week. Shows that the variables can change so quickly, even overnight. All right, everybody. More next week.